6 weeks. That is how long it took for a third of South Korea's stock market to disappear. Not a crash you read about, not a headline anyone here ran with. An entire country's savings quietly cut in half again, while the rest of us argued about whether the AI bubble was even real. Everybody spent this year arguing about whether the AI bubble was real. Almost nobody asked who was standing closest to it. And the answer turns out to be a country of 52 million people that spent this year building the single best-performing stock market on Earth. In the first half of 2026, the Kospi nearly doubled, not rose, doubled, the largest gain of any market in the world. The second quarter alone was up 67.7%. To find a quarter like that, you have to go back to 1998. 1998 comes back later. It matters more than it sounds like it does. So what changed? Really? One thing. Chips. In June, semiconductors were 43.8% of everything South Korea sold to the world. $44.8 billion in a single month. That was up almost 200% from the year before. First quarter GDP grew 3.6%, the fastest since 2021, and almost all of it came from one place. Chip exports up 151%. At that point, you are not really running a diversified economy anymore. You are running one industry with a country attached to it, and it matters enormously. Which? Chips. Because Korea does not really sell the chip that thinks, it sells the chip that remembers. Every AI model, while it is running, has to hold an enormous amount of information somewhere it can reach in nanoseconds. Not storage, working memory. That memory is called high bandwidth memory, and it is stacked in layers, and it is extremely hard to make well. Two companies in the world are good at it at scale. Both of them are Korean, which sounds like the strongest position in the AI supply chain. And for about 18 months, it was. Here is the problem with being the only supplier of a critical part. Your revenue does not depend on how good you are. It depends on how long your customer keeps ordering. And AI orders have a particular shape that makes this worse than normal supply chain risk. They are not sales. They are construction budgets. Somebody decides to build a data center. That decision produces 2 or 3 years of memory orders, all at once, decided in a single meeting by a small number of people. Which means demand does not soften gently when sentiment turns. There is no slow decline in enthusiasm. There is a budget, and then there is a revised budget. Korea built an entire national growth story on the second kind of number. Now, 1998. In late 1997, South Korea ran out of foreign currency. Companies had borrowed heavily in dollars, and the dollars stopped coming. The country took an emergency bailout from the International Monetary Fund, the largest of its kind at the time. What happened next is the part Koreans remember, and most other people have never heard. Ordinary people lined up to donate their own gold. Wedding rings, medals, baby bracelets, millions of them handed over to be melted down and sold for foreign currency, to pay down a debt that they, personally, had not taken on. That is the memory sitting underneath this market, not a chart, a line of people giving away their rings. Which is why what happened this year is so uncomfortable to look at. Because this time, the leverage was not on the companies. It was on the households. As of the end of July, individual retail investors were 40.1% of all Kospi trading volume. In the United States, that figure is about 17. So this was not funds rotating into a hot sector. This was the public, nurses, teachers, delivery drivers, retirees. And the number that matters is not how many of them bought in. It is what they bought in with. Credit loans, overdraft accounts, and leveraged ETFs. Most people who buy a leveraged fund have not thought the second half of that trade through. A 2 times leveraged fund is built to move twice as much as the thing it tracks. Index up 5%, you are up 10. And that works exactly as advertised, in both directions. But there is a second thing these funds do that is much less obvious. They reset every single day. Which means in a market that swings hard in both directions, you can be right about where it ends up and still lose money getting there. Add it all together. By the end of the second quarter, South Korean household debt crossed 2,000 trillion won for the first time in recorded history. That is more than the entire country produces in a year. Household debt above 100% of GDP, among the highest in the developed world. So a country borrowed at record levels to buy an index that is roughly half two chip companies, whose revenue depends on AI spending staying exactly as high as it is right now. And a meaningful share of that was bought through instruments that punish you twice for being wrong. Every single piece of that has to keep working, all of it, at the same time. And there is one more mechanism here, and honestly, it is the one that turns a bad week into a bad quarter. When you buy shares with borrowed money, the lender does not simply lend and wait. They hold your shares as collateral, and they set a line. If the value of that collateral falls below the line, they call you. And a margin call is not a request. You either add money within a day or two, or they sell your position for you, at whatever the price happens to be that morning. That is one person. Now do it to a few 100,000 of them on the same morning. Prices fall. Collateral falls with them. Calls go out. Shares get sold, and not because anybody decided to sell. Because a number went under a line. Those sales push prices down further, which puts the next batch under the line. This is the part people mean when they say a market fell faster than the news. The news stopped mattering. The mechanics took over. 40% of the volume was retail. A lot of it was borrowed. You can work out the rest. Percentages are very good at hiding what they do to an actual person. So put a number on it. Say you are an ordinary earner in Seoul in the spring. The market is up 67% in a quarter. Everyone you work with is in. You put in 50 million won of your own money, around $35,000, real savings, years of it. And because the fund you like is a 2 times fund, your exposure is not 50 million. It is effectively 100. For a few weeks it works beautifully. On paper you are up more than you earn in a year, and you have done nothing except be early. Then the index falls a third. At 2 times, a third is not a third. And that is before the daily reset, and before the day the lender calls, and before the morning your position gets closed, at whatever the screen says at 9. Nobody in that story did anything reckless by the standards of the room they were standing in. Everyone around them was doing it. The market had gone up for 6 straight months. That is the part of leverage nobody warns you about. It multiplies the money, obviously. It also multiplies how completely normal the whole thing felt on the way up. In the middle of the year, it stopped working. And stopped working is a strange way to put it, because nothing actually broke. Samsung did not lose a customer. Hynix did not lose a factory. No building burned down. No fraud was uncovered. Demand for memory did not go to zero. What changed was a question. People started asking, out loud, whether the companies buying all these chips were ever going to make money back on them. That was the trigger, not a fact anybody could point at. A question that a lot of people started asking at the same time. But when a market is priced for everything going right, and levered on top of that, a doubt is enough. Over 6 weeks, the Kospi gave back more than a third of its value. SK Hynix alone lost roughly $560 billion of market value. That is more than the entire annual output of most countries on this map. On the 19th of August, the index fell 6.6% in a single session. The next day, it rose 5.9% and closed at 6,852. Down almost 7, up almost 6, inside 48 hours. Markets only move like that when nobody in them has any real idea what the thing is worth. And remember who is holding the 2 times funds while that is happening. SK Hynix responded the way a company responds when it is trying to put out a fire. It announced it would spend 40 trillion won, about $29 billion, buying back its own shares. A buyback does one honest thing. It reduces the number of shares, so each remaining share owns a slightly bigger piece. The rest of what it does has nothing to do with arithmetic. It is a company spending $29 billion to say out loud that it thinks its own shares are cheap. That tells you what the people running the company think. It does not tell you where the price stops. On the 26th, it moved again. Index down 2%. Samsung down 3%. Hynix down 6%. Not because of anything that happened in Korea, because Nvidia had an earnings call coming. 52 million people, 2 companies, and 1 date on an American earnings calendar. There is one more piece, and it is the part Korea can do the least about. American officials have been pressing Korean chipmakers to move more of their production into the United States. From an American point of view, that is completely rational. You do not want the memory for your entire AI industry made inside artillery range of a border you do not control. But look at what it means from Seoul. The one industry holding the market up is the same industry being negotiated, piece by piece, out of the country. So people keep asking whether the AI bubble is going to pop. I do not think that question gets you anywhere. Bubbles do not pop everywhere at once. They pop where the leverage is. And there is a second country you should be watching for exactly the same reason, which almost nobody frames this way. Taiwan's index is even more concentrated than Korea's. One company, making the chips that do the thinking, sitting at a similar share of an entire national market. The difference is that Taiwanese households did not lever themselves into it at anything like the same rate, same concentration, different fuel. Concentration decides how far a market falls. Leverage decides how fast, and who is still standing at the bottom. And right now, the leverage is not in San Francisco. It is in a household loan, on a phone, in a 2x fund, in an index that is half 2 companies. Korea is not the exception to the AI trade. Korea is what the AI trade looks like when somebody finally makes you show the balance sheet. Everyone else just has not been asked yet. And the country that already got asked has done this before. They know exactly what it costs and exactly who ends up paying for it. It is never the people who built the leverage.